All right, good afternoon. Welcome to 25 Minutes with Cap. Today we're going to discuss what we've been describing as the uneven management liability market. Certainly the hard market headlines have spotlighted public company D&O, and with good reason. But there's also significant changes happening in other areas of management liability. Private D&O, healthcare D&O, specifically managed care D&O and E&O. For private D&O, how are insurers adjusting to the rise of insolvency in the private company market, many of them due to COVID-19? Have antitrust exposures in the healthcare business moved toward that coverage being uninsurable? So who better to discuss this with me than Eric Berens, our head of D&O here at CapSpecialty. Eric has a few decades of experience, all of them in management liability, whether public, private, or healthcare. Eric, thanks for joining.
Hey, thanks, Adam.
Great. As we go on from here, as you have questions through the session, feel free to enter them into the chat. We'll do our best to answer them. We've already received a bunch of questions and we'll look to address some of them in the next 25 minutes. So Eric, first question. As we started off the program, in professional liability, the most celebrated hard market so far has been public D&O. We've been seeing halving of limits, gigantic rate increases, yet you've already noted that the end of this trend, at least, is near. How did it happen so soon?
Yeah, I don't know if the rate or all the rates, is starting to plateau, but we kind of got spoiled as D&O carriers last year. So we came on board writing the excess public and private in October of 2019. And a few months into it, I started to hear a lot of things like, hey, Eric, the layer under you inverted. Let's do this thing, 110%. Over excess. Or you would get something like, hey, look at this. It was going at 70% last year. Now you can do it at 90. Let's do this deal. You were hearing a lot of excitement and you're looking at risks that were otherwise okay, but you're getting a lot of increased limit factor and you're watching the SIRs increase from 2.5 to 5 million on the primary. It was pretty exciting time. You would get calls, hey, I just need a 2.5. I got two markets here that you can quota share with, or another market, and we can make it a 10. 10s were being reduced to 5s. 5s were being reduced to 2.5s. It was a crazy time. Now, come to end of the fourth quarter into January, you're really seeing the almost polar opposite, where now there's a little bit of brave juice in the water given the frothiness of the rates. And you're seeing primaries now going from 5 back to 10, puts pressure on the 5x of 10 to do a 10x of 10. And so we're starting to see more and more come now last month and this month, the traditional retail-oriented markets popping 10s, which is displacing those that have the 5 up higher to compete on the higher levels of the excess. So you're starting to see those ILFs that were once 90, 110%, fall right back down to 70. So we're definitely seeing some changes on the most celebrated public D&O front pretty quickly.
See, even if the rate is getting flatter, is it still robust enough right now?
Oh, definitely. Because even when we're looking at the magic of these 10s the last couple months, it's still like a 10 or 15% overall increase on that rate per mil on that attachment point. So it's still there. You're just not doing the quick high five because you got a 50% rate, change year over year. So it definitely looks like it's starting to plateau, and the capacity is really coming back. So the story really isn't just the new markets, but really these legacy markets. Some of these chief underwriting officers are letting the animals out, and they're starting to forget why they went back to 5 in the first place.
Sure. Is there anything special underwriters need to be thinking about with respect to coronavirus exposure? And we'll talk about it with respect to public or private business. Certainly everyone says, well, okay, yeah, coronavirus exposure. But what's one thing that you think would surprise the audience?
Yeah, I don't know if I have anything to really surprise the audience that does this on a day-to-day basis, but maybe some of those that are just sort of like popping in just to hear a little bit about the D&O marketplace generally. When the pandemic first hit about a year ago, all these client meetings that you'd have on the Zoom or the WebEx, everything would be, all right, before we get started, drill down these 10 or 15 COVID questions. So you get the CEO or CFO of a publicly traded company, and really it would be like rote, right? They just go down, they talk about the PPE, they talk about their financing, they talk about waivers of like leases, rent, etc. And then you would kind of learn about the management team, you'd learn about the operations, that type of meeting. Then on the private side, you would get all these private carriers that would say, well, you got to fill out our 1, 2, or 3-page COVID questionnaire, and you may or may not got a complete questionnaire back. But it was definitely something that was in the forefront. Now, a year out, you're not getting that same story. You're not getting those same questions. And I think there's obviously some reason for that. But going forward, I think the surprise might be is that there's kind of like this COVID part 2 of what happens when now that the economy is emerging, you got winners and losers. And for instance, technology's done great. So a tech company I was on a call with, and they're afraid now to give guidance because they don't know if all the customers that they acquired during the pandemic are going to stay with them, right? So that could be a negative on a positive. You have retail that they were able to shed about 30% of their business, their footprint, their expensive retail footprint, get rid of that, go online, go omni-channel, and now they're cash flow break even. So it's kind of a mix coming out of the pandemic. So I think that those are the questions, is how the pandemic has treated you and how you've kind of gone through it versus that checklist of, you know, where you at, PPE, that financing.
Sure. One of the other trends we started seeing in the D&O space, particularly around headlines around GameStop, AMC, American Airlines, Roaring Kitty, the short squeeze phenomenon. How is this changing public D&O underwriting? Have we always been underwriting for this? Or we were supposed to be, but not really?
Well, you know, you always got that one eye on everything that's everything, right? But to be honest with you, it's even on the public D&O, it's such a high volume. I think anyone in the business today doing the public, you're probably just shaking your head in agreement with me. There's way too many Zoom and WebEx calls for these client meetings. I have 2 or 3 a day. I have 2 other underwriters that have 2 or 3 a day, sometimes at the same time. So you got your 2 cell phones going. You got to go through the WebEx. You're trying to monitor everything. So you got all that issue, and then you got this thing about like hedge funds and squeezes. You're like, what's this sneaking up on you, right? You're so busy. You're doing your underwriting, and it's now something that we look at. We definitely look at the amount of public flow and the percentage of that flow being shorted. But prior to the GameStop and the AMC theaters, we really didn't look at it. But it's definitely something we definitely look. You don't want this overvalued GameStop or some other entity on your books figuring, what's going to happen with it. So far, though, I haven't seen any claims come out of these.
So do you now have Reddit and Wall Street bets up next to your, whether it's Bloomberg or Advisor terminals?
Yeah, I mean, Advisor told me I didn't have to add anything else, but definitely it's on my to-do list. I don't know if you can see it from the WebEx, but it's totally the next thing I need, right? Get that inside scoop on the next short squeeze.
So while it hasn't seen the same type of headlines, private D&O is involved in a slow burn right now. I have to imagine that every single hospitality firm went through significant layoffs in the past year, exacerbating EPL exposures. And if that was their only issue, then maybe they were lucky. The amount of insolvencies coming out of the past year has been enormous. How bad is it going to get for private D&O underwriters? What are your predictions for this market?
All right. I'm thinking, Adam, it's going to be bad. I don't mean to say it. It's going to be really tough. I know that prior to the pandemic, because we did a lot of analysis on private books coming to Darwin in some of my legacy companies. At that time, good underwriters with definitely good structure and coverage, they're barely making 100% combined ratio. And that's when times are pretty good and you're starting to get those incremental rates. I think it doesn't take much to rock a book of EPL, entity everything coverage, and 100% predetermined defense costs. It's just such a toxic mix, as litigation is just always going out, more M&A transactions, a lot of PE in other opportunities, and cash inflowed into the private company world. Now we're talking about SPACs taking private companies public. You added all of that, and then you got the issues created by the pandemic. You got the layoffs, the insolvencies, the poor access to capital, or not as much access to the publicly traded companies. It's kind of a double burn. So there needs to be really two reasons. There's really two reasons why this market is starting to harden. So you got all of this claims issue that needs to be addressed, but then you also have this need to treat the private company business differently. It always used to be get your unskilled, your new guy, cut his teeth on the private books, or we're so smart we can ask 4 or 5 questions and put it through a machine, and we can quote primary, D&O, and EPO. Well, I think those days are gone, at least now, and there really is an effort and a need to have this business handled by people that really know the coverages and the risks, and kind of putting the dotted lines together on these incomplete private company submissions. The cost of putting the right business on the books, it's definitely increased. So it's going to hit them 2 ways.
Well, but there's a need to do it, but are you actually seeing it happen? You know, the types of accounts that you'd expect to go through a portal, is that not going through the portal anymore? Or is it just that the portal is going to need to, it's just going to take a while to react?
Well, I love the portal accounts as a majority access writer, because those are the ones where I can say, hey, look, I just inverted. So I can't invert my excess of the public D&O anymore, but on a private marketplace, because it's fractional on the inadequacy of the underwriting, and they're still shooting out the quotes, that a primary 5 going for $18,000 gets shot out, and then I can do a 5X of 5 for $30,000, and there's no one that's going to beat me. So it's still there, but I think it's just a matter of time before that adjusts as well, because it's definitely a gap in the market.
You know, before you were talking about how broad the private company form is, and it's broad. Do you think that there's going to be any type of long-term effect from this changing market? Do you think that you're going to end up seeing any types of wholesale restrictions of coverage?
Yeah, you're starting to see, and I'll go into that a little later, I think, but on the side A, it used to be the freebie 1 million dedicated excess for executives, that floating 1 million side A. That's going away. You're seeing absolute breach of exclusions on the contract. You're seeing the 4 on the BIPD becoming an absolute. So you are seeing some of those being taken away, along with no more carve-outs for the insured persons. So it's you can see it already.
You know, one of the areas that I think we talked about a couple of months ago on this webinar is California employment practices. And is there any sign that could end up being profitable?
No, I think there's some business that almost can't be. You kind of have to self-insure it, or maybe think of some kind of like maybe state tort reforms or litigation reforms. It's very, very difficult. It's not easy, and it's not just EPLI. It's other lines of business as well.
Sure. Okay, turning toward the healthcare business. So we talked a little bit about managed care before. The managed care liability market's always been a very niche area with specialized underwriters and specialized brokers. Despite the fact that the past year has been a pretty good year financially for these entities, the management and professional liability market for them has been tough. Are the claims still outpacing the rates? Are you able to underwrite around exposures, or the most current exposures, and where do you see opportunity here?
Yeah, so the managed care marketplace, in a sense, I'm not going to use the word club, but it's really kind of a finite group of carriers, particularly on the managed care E&O, that either brokered together, underwrote together, cut their teeth in some form or another, and they sort of spread out. So it's like 4 or 5 carriers that can do the primary. You got a handful on top of that that are going to be able to do your excess. It's a marketplace that's really tight. The claims trends have actually been fair. Rates are still going up. The demand for the capacity is there, but the payouts are kind of the problem. If that Blue Cross Blue Shield is definitely a big watermark for this line of coverage, where it's kind of like there's 2 parts to that class action, the multi-litigation state action back a handful of years ago, actually probably 8 or 9 years ago now, where they're just paying out. So the checks are still being cut. And so when you're cutting those checks, you got the reinsurers, because I know that when we got into the business, there was definitely a lot of education and learning in working through, and there's really no new capacity there. So it's really niche-y. There's been big payouts in the past, and it's not like easy and a lot of uncertainty. Every administration that comes in, the rules seem to change, and yeah, it's one that's really frothy and different from the public D&O and similar to the private. It's really hardening pretty quick and not much end in sight.
Is the opportunity in this business around current insureds and their changing programs, or are there actually a lot of new businesses being created that fall into this category?
Yeah, on the mid to larger excess, it's not really anything new being created. I think it's on that smaller primary play that like 100 million, 150 million in revenue and less managed care entity. You'll see some startups. You'll see these clinically integrated networks, and they're going to want their own managed care coverage. And you know there's going to be a whole new development of risk management entities with the new administration and the rollouts from CMS. So yeah, there's growth in the small. I think that mid to larger, it's kind of finite at the moment.
You know, so we've talked mostly about D&O, but how have the E&O exposures evolved in that space? Is it still driven by utilization review, or are there new trends to note?
Yeah, well, we've talked about it a little bit here. Well, it's no secret that the antitrust is really that driver on the claims. It's kind of that hybrid D&O, E&O exposure. We've seen claims, contracting, establishing networks, but sort of that pure play, old-fashioned E&O claim. Yeah, utilization review is a big one. Claims handling, those are 2 that are always on the loss runs. I think that's just the reason for the coverage. It's always going to be there and something to underwrite for.
Right. Thanks. The turning to the A-side business. So the A-side product has evolved from being only in the domain of larger public companies and has now moved more toward the SME space. How important is it for mid-sized private companies to buy A-side coverage? Is it just window dressing, or is there real value here?
Yeah, I honestly say it depends. I can't sell A-side to everyone. It's really unique to the situation, their budget, their risk tolerance. There's a bunch of decisions involved. Saying that, I definitely believe in the aggregate, there is a shift and more of a need for these companies and the individual directors and officers to think about buying it and pulling the trigger in short order. You got 2 drivers here. You've got the products, right? The products, the coverage is rolling back, insured person coverage, entity coverage, and also the prices are going up or limits are being reduced. So in order to preserve limit continuity for the insured person, the A-side is a great cost measure there. But further, with these like A-side, 1 million jump up limits on the primaries being eroded or taken away, we're actually getting calls saying, hey, Eric, can your team do a 1 or 2 million lead A-side DIC over just private company risk? Because the primary is taking coverage away. So we're seeing some opportunities there. The other thing is there's real claims going on that we talked about earlier with the insolvencies, with the insured persons being more held accountable for paying out of their pocket. And the private companies, I just like to add, they don't indemnify like the publicly traded companies do. So you got to really look at the coverage and the triggers and how not indemnified is spoken about or defined in your policy. The lead ace ID I see definitely covers that company may decide on their own if they want to indemnify because they say, you know, we don't like you, we think you committed fraud, where they could leave their former DNO or maybe CEO that they're having issues with, they're not going to cover. So it's definitely something for the private companies to look at adding to their DNO tower.
Hey, Eric, we got a question in here. It was in private management liability, you have excess that excludes various underlying coverages like EPL and fiduciary, but also drops down over specific sublimits of other coverages. Have we seen any issues or conflicts there?
Yeah, the private excess underwriting is actually more complicated than the public. It sounds bizarre, right? But it's true because your private form, you could have the DNO, the EPL, the fiduciary, the crime, K&R, etc. And then you got all these sublimits. So then you can have like an antitrust sublimit. You can even have third-party EPL sublimit. You can have a regulatory sublimit. So then what happens is the first layer might only want to do excess over the DNO and the EPL. Maybe they're separate limits. So then it's an aggregate. So then you got to make sure that's done right. And then maybe that next excess layer is DNO only. So that carrier's got to exclude things differently. They got to exclude the EPL if it's a separate limit, not recognizing erosion. But let's say the fiduciary was attached to it. Do you want to recognize erosion? If it's an ESOP and they build the coverage up where the DNO and the fiduciary is tied. And then there's the drop down. So it can get really complicated. You're doing a 1x of 1 on a reg. There's the 50% coinsurance on the reg. Does that need to be endorsed on the excess? Maybe. My favorite is, and it's one that's sometimes inconclusive, are these primary policies that say, I'll give you a 5 million sublimit of antitrust. The limit's 5 million. Does that excess carrier then consider that part of the 5 or a sublimit where that excess form says doesn't follow form over sublimits? So there's a lot of crafting that needs to go on these. And when we see some issues as excess carrier, we tend to work with our wholesale broker to point it out or maybe offer a different solution.
Another question we got in here on the managed care, there seems to be a slow paring back of coverage as you increase position on the tower. Can you explain?
Yeah, so this is an interesting phenomenon. So you got the smaller group of players on the managed care, but they all, like anyone, have their own tolerances of risk and what they want to do with their book of business. So antitrust, I'll start with that. That's kind of the easy one. You'll have some carriers that believe that, you know what, it's a smaller Blue Cross Blue Shield plan or a smaller Delta Dental, what have you. We'll provide full antitrust coverage, no conditions, fine. So then the first layer excess is going to say, you know what, I can't support that, but I'll give you capacity. I'll give you antitrust, but I need to carve back for what's called the association antitrust claims. So anything that would be related out of like a Blue Cross Blue Shield that had antitrust to it would be excluded. That's okay. So then that next layer is to say, well, I kind of like this program, but I'm really hung up on opioids. And I think the opioid issue could bite us here. They have a subsidiary that's a pharmacy benefit. Okay. So then that next layer, that second layer, now has the association antitrust and the opioid. The following excess layer will then say, well, you know what? I think this is great that you got the opioid, you got the association antitrust. Cyber is kind of a big deal, right, everybody? I'm going to put a cyber exclusion on this thing. So that's kind of like the pyramiding of the decreasing coverage as you go higher. And the increased limit factors are pretty healthy. 80, 85, sometimes 90, every once in a while an invert. So,
Eric, is there any type of consistency in how people are charging for that? What people are charging for taking, how much they're valuing taking opioid coverage away on a 5X at 25?
See, it's like anything on these deals. It really depends on the risk. Some of these risks are so large and they need the capacity, they can kind of self-fund a tower that's petering out. So if you have hundreds of millions of dollars of cash on the bank and you're buying a $60, $70 million D&O program, it's it's all relative. And in this marketplace, once you get that tower over 65, 70, 75, and you try to build a 100 million tower for your insured, you're talking about going into captives, you're talking about being creative with capacity. It's really one of these, let's get the capacity first and figure out all the details on how much coverage you can get second.
Awesome. Well, hey, Eric, that's our time here. Really appreciate everyone tuning in. We'll put this up on our YouTube channel in a couple of days, probably. If you have any questions that you think of coming out of this webinar, feel free to send Eric or I a note, or give us a call. You have all of our contact information. Thanks a lot.